Hey everybody, welcome to Mortgages Today for Wednesday, August 2nd, 2023, and oh, what a day it was. Rough start to the morning. MBS were down 39 basis points in the morning. Stocks lost 31 points real bright and early. Yesterday, Fitch Ratings downgraded the U.S.'s credit rating by one notch from a pristine AAA to AA+. In 2011, the S&P was the first to downgrade the country's rating from AAA to AA+, and that downgrade caused substantial market ruckus. This downgrade will have at most minimal negative impact, but is indicative of the increasing political brinkmanship and eroding fiscal competency. Moody's continues to rate U.S. government debt as AAA. A downgrade sounded like a big deal, but bonds didn't trade news at all when they opened the Tokyo trading a few hours later. Echoes of last month when ADP obliterated expectations and sent bond screaming yield higher. This time around, the beat was not quite as severe, but more importantly, markets are quick to remember that the NFP data that followed last month's ADP. In short, the ADP was a big old false alarm, so it's not getting nearly as much attention today. But it did come in at 324,000 on a 189,000 forecast. It was 497,000 previously, though last month's huge 497,000 was lowered by 42,000 today. Still a huge number. Wage growth continued to decelerate. Workers who stayed in their jobs experienced a 6.2% pay increase in July from a year ago, the slowest number since November of 2021. For those who changed jobs, the median rise in annual pay was 10.2%, the slowest in 2 years. I've been saying for a while that I think that is going to be the number that is going to determine whether or not we go into a recession. That number has to go to zero or even negative. Otherwise, people are just going to keep racking money up on their credit cards, and as long as we have wage growth, they can still make that minimum monthly payment and kick that can down the road. The scheduled unveiling of new Treasury auction amounts has been met with a bit of additional weakness in bonds in the mid-morning. Plans are much higher than expected. They forecast $1 trillion will be raised July through September, up from the $750 billion expected. July saw $95.6 billion of MBS slide out of the factory, a 7.8 decrease from June's $103.8 billion. Blame the heat, blame whatever you want. In fact, the month of June was the first to see over $100 billion in gross issuance since last September, and the collapse in refi-sourced mortgages certainly has been a driver of the trend in lower supply. Bond yields spiked to their highest levels in more than 8 months this morning following another upbeat ADP report. At first glance, it was a repeat of last month's ADP reaction, not something that made perfect sense given that last month's ADP didn't align well with the NFP 2 days later. In today's case, the amount of weakness attributable to ADP was much smaller than last time. Instead, it was the bond market's digestion of the Treasury refunding announcement, which pushed a bunch more supply into the market. 10-year auction sizes were a bit higher than expected, and the Treasury's buyback program was a bit lighter than expected. Longer-dated bonds took a hit, while 2- to 3-year Treasuries actually improved. At the close, MBS lost 17 basis points at 98.69. Stocks lost 63 points. I guess everybody hates money today. So at 98.69, that puts us down in this lowest range, ceiling at 98.716 and a floor all the way down at 98. If we hold in that range, we're probably gonna have to start looking at some different coupons. But not everything is bad news. Rhythm Capital, formerly known as New Residential or New Res, announced second quarter earnings that were just about the company's best ever. What? A mortgage company having a best quarter ever? Rhythm had one of its best quarters ever. The CEO and president said, "We had near record earnings, grew book value, acquired $1.4 billion in consumer loans, grew our single-family residence business with the acquisition of 371 units. Subsequent to quarter end, we announced the acquisition of Sculptor Capital Management. This acquisition helps accelerate our growth in the alternative asset management space as Sculptor's $34 billion in AUM complements Rhythm's $7 billion in permanent equity capital and $30+ billion balance sheet. With the introduction of new capital market rules being instituted on banks and the highest level of rates seen in 20+ years, the investing environment has not been this good in years." So I guess somebody's figuring out how to make money.